What is order block and how can you draw it in the forex market? Trust me, if you pay attention to this video very well, this would be the only video you will need to watch about order block. Let's get started. All right, so basically, an order block is just a zone in the market where big financial institutions or smart money, hedge fund, or whatever you can call them, place their large buy or sell orders with the aim of moving price from one level to another level. Okay, so they usually do this whenever they spot an area in the market that they consider cheap, because the aim why they are buying or selling is because they consider a particular price level cheap in the market. Okay, so they usually accumulate a lot of orders from that particular level. So where these orders are being accumulated from is what we call an order block. Okay, so they usually leave this footprint in the market for we, the retail traders, or anybody who can identify them to see. And this act as an opportunity for us to place or enter a trade in the market. So let me break down for you and how you can actually identify this order block in the market. So basically, we have two types of order blocks in the forex market. We have the bullish order block and we also have the bearish order block, which I'll be talking about two of them in this video. So the bullish order block occurs when the market hit a key level in the market, okay, either support level, which I denoted by S, okay, or a resistance level, which I will also denote by R, okay. So let's start with this one here, the bullish order block. So whenever the market hits a support level, institutions and big players will be looking to stack position from this zone, okay, because initially the market was trending down, right? Then eventually hit a key level. So they will start looking for stacking positions because they want to push what price to the upside. So when they do this, they are going to leave this footprint for us, okay? And this is what we now identify as order block because they have stacked up a lot of orders from this zone, okay? So a bullish order block is basically the last candle, okay? The last opposite candle before the impulsive move to the upside, okay, for a bullish order block. So let's say this is the last opposite candle because the market has been selling, right? So this is going to be the last sell candle before this impulsive move to the upside. So this is going to be our order block. So what you are going to do in this situation now is that you are going to mark the wick of the last opposite candle, the wick of it. You mark it and then you extend the line just like this, okay? So once you mark it like this and extend it, you wait. Because whenever the market come back into this zone in future, it's going to present an opportunity for a buy, okay? So I want you to pay attention to this piece of information I will give you right now, okay? For an order block to be valid, okay, it must take out liquidity, okay, of the last candle before it hits a key level. Let's say this is our key level, right? Or this is our support level. There are going to be some liquidities below this last candle. So the market needs to take out the liquidity. You can see how the market took out the liquidity before it hit the zone. So the moment the market took out the liquidity and then tap into this zone, this is my number one observation that, okay, this is going to be a valid order block. And my number two observation is that there must be a fair value gap, okay? So this is our fair value gap, right? This is our fair value gap. So whenever the market took out liquidity and create a fair value gap, then this order block become a valid order block. So in future, whenever price come back to this zone, we are going to anticipate a reversal. So this is very simple, okay? So whenever you are looking out for your order block, make sure that the order block actually took out liquidity and create a fair value gap. And when you take trade from such order block, you are going to have high win rate, okay? So let me talk about the bearish order block as well. So basically, a bearish order block is just the opposite of a bullish order block, okay? Let's say the market has been trending up, okay, until you get to a key level right here or a resistance level. Because this time around, we are looking for what? Sell opportunity, right? So whenever the market gets to a resistance level, which I denote by R, institutions are going to start stacking their positions, right, to change the market direction. So whenever the market hit this zone, you are going to pay attention to the last candle, okay, the last candle, either the last opposite candle or the last candle before that powerful move to the downside is going to be what? Your bearish order block. So you're going to mark this candle like this from the wick of it, and you extend this line into the future. Why do you do this? We do this because we are waiting for price to return back to this zone, okay, with other confluences that we use to anticipate our trade reversal. So whenever the market actually make the move back to the order block, then we're going to look for what? Confirmation to sell. So, and also for this order block to be valid, it must also take out the liquidity of the last candle, okay? There are going to be some liquidity that are resting above the last candle before the key level. Once the market took out the liquidity like this, we are going to, have an impulsive move, okay? So this zone now become our order block. And you can see how this order block here creates what? A fair value gap, which is also known as imbalance. Okay, so once these two things are present, then we can see that this order block is a very valid one, and we can look for trade opportunity from that zone. So I hope you learned something from this video. If you do, kindly give me a like and a follow for more tips, and I will see you in the next video.